Most people will work for 40 years, save diligently, live below their means, and still die with less money than Jim Simons made in a single afternoon. That is not an accident. That is not luck. And it is certainly not because those people were lazy or unintelligent. The painful truth that Simons understood and that the middle class has never been taught is that there are two entirely different sets of rules operating in the financial world. One set is taught in schools, reinforced by parents, and repeated on television. The other set is whispered quietly in the halls of institutions like Renaissance Technologies, where mathematics replaced emotion and where patterns replaced predictions. Simons did not beat the market occasionally. He beat it consistently for decades, with returns that made Wall Street's best look like amateurs. And the gap between what he knew and what the average person believes about money is so wide that most people cannot even see it exists. That gap is what this video is about. Simons spent his career watching people make the same financial mistakes over and over again. Brilliant people, educated people, people with good jobs and strong work ethics. And he noticed something that most financial advisors will never tell you. The problem was never income. The problem was the framework. The way someone thinks about money determines every decision they make with it. And if the framework is wrong, it does not matter how hard you work or how much you earn, the outcome will always be predictable, and not in a good way. So today, we are going to break down the rules that rich people follow, the ones the middle class was never taught, through the lens of Jim Simons' mathematical mindset. Not theory, not motivation, pure logic. The first rule is this: the middle class trades time for money. The wealthy build systems that generate money from money. This sounds simple. It is not. Because understanding it intellectually and actually internalizing it are two completely different things. Simons recognized early in his life that there was a ceiling on human effort. A person has a fixed number of hours. Even if you are the most productive human alive, you are still constrained by time. So any strategy that depends on you doing more, working harder, or staying later is a strategy with a mathematical ceiling built into it. You cannot outwork the limit of 24 hours in a day. The middle class does not see this ceiling because they are too focused on the floor, on paying bills, on surviving the month, on getting the next raise. They never look up long enough to notice that no matter how high they climb on the ladder of effort, the ladder itself has a top rung. Simons approached this differently. He asked a different question. Instead of asking, how do I earn more? He asked, how do I build something that earns without me? This is the foundational shift. When Simons built Renaissance Technologies, he was not building a place where smart people came to work harder. He was building a machine, a system, a mathematical engine that would identify patterns in markets and execute decisions faster and more consistently than any human could. The system did not take vacations. It did not get emotional after a bad week. It did not second guess itself at 3 in the morning. It just ran, and it generated returns because the logic was sound, not because someone was grinding away at a desk. Think about this in practical terms. A doctor earns well. A very good doctor might earn exceptionally well. But the moment that doctor stops seeing patients, the income stops. The income is entirely dependent on the continuous exchange of time for money. Now, imagine instead that the doctor used a portion of that income to build or invest in a system, a set of assets, a business, a portfolio of investments that generated returns independently. Suddenly, the doctor is no longer just a doctor. The doctor is a node in a larger network of value creation. Simons understood this not as a lifestyle choice, but as a mathematical inevitability. Compounding only works on systems, not on salaries. And the longer a system runs, the more powerful it becomes. The second rule is one that almost no one in the middle class ever confronts, honestly. Emotion is not a feature of financial decision making. It is a bug. Simons did not say this to be cold or indifferent to human experience. He said it because the data was undeniable. Every time a human being makes a financial decision based on how they feel, on fear, on excitement, on pride, on the desperate need to be right, the outcome is statistically worse than a decision made on pure logic and evidence. This is not opinion. This is measurable. Consider what happens in a market downturn. Prices fall, uncertainty rises, and the average investor, gripped by fear, sells. They sell at the bottom, locking in their losses, and then they wait. They wait until the market has recovered significantly, until the news sounds optimistic again, until it feels safe, and then they buy back in near the top. Buy high, sell low. It is the exact opposite of rational behavior. And yet it is what the overwhelming majority of people do repeatedly, because they are making decisions with the emotional part of their brain instead of the analytical part. Simons built his entire operation around eliminating this pattern. The algorithms at Renaissance did not feel fear. They did not feel greed. When the data said buy, they bought. When the data said sell, they sold. Emotion was simply not a variable in the equation. There is a concept here worth understanding called the interference of intuition. Human intuition is powerful in many domains. If you are a carpenter who has built 1,000 tables, your intuition about wood and joints is valuable. But in financial markets, which are complex, dynamic, and specifically designed to mislead pattern recognition in the human brain, intuition is almost always a liability. The market is not a physical environment that your senses evolved to navigate. It is an abstract probabilistic system. And your gut feeling about what the market is about to do is, statistically speaking, worth very little. Simons knew this. And so he removed the gut entirely. He replaced it with code. He replaced it with math. He replaced feeling with evidence. And the results spoke for themselves. The third rule is one that cuts to the core of why the middle class stays in the middle. Most people avoid complexity because they fear what they do not understand. The wealthy, and especially those with Simon's mindset, lean into complexity because they know that complexity is where the mispricing lives. Let that sit for a moment. Every time something is poorly understood by the general public, it creates an opportunity for someone with better understanding to profit from the gap. This is not manipulation. This is arbitrage of knowledge. Simons built his career on finding signals in data that other people could not see, not because the data was hidden, but because most people lacked the mathematical framework to interpret it. The information was available to everyone, but the ability to extract meaning from it was not. This is the knowledge gap, and it is the single most underappreciated source of wealth in the modern economy. When most people hear about complex financial instruments, quantitative strategies, or probability-weighted models, they shut down. Their eyes glaze over. They tell themselves that this is not for them, that it is too complicated, that only specialists can navigate these waters. And in doing so, they voluntarily step away from the exact spaces where the greatest opportunities exist. Simons once reflected on the nature of discovery, noting that the biggest breakthroughs always came from asking questions that others had dismissed as too complicated to bother with. This mindset, the willingness to walk directly into confusion and stay there until it becomes clarity, is not a personality trait that Simons was born with. It is a discipline. It is a choice. And it is one of the most financially consequential choices a person can make. Because when you commit to understanding what others refuse to engage with, you position yourself on the right side of the knowledge gap. You become the person who profits from the mispricing instead of the person who creates it by trading in ignorance. The practical application of this principle does not require you to become a mathematician. It requires only that you commit to consistently expanding your financial literacy. Read the things that seem intimidating. Sit with concepts until they become familiar. Ask the questions you are afraid sound stupid, because every piece of financial knowledge you acquire is not just information, it is an edge. And edges accumulated over time compound just like money does. The fourth rule is perhaps the most counterintuitive, and it is the one that separates Simon's most completely from the way the middle class thinks about success. The middle class celebrates being right. Simon celebrated having a process that was right more often than it was wrong, even if any individual outcome was a loss. This is the probabilistic mindset. And most people never develop it because the education system and popular culture train us to see failure as something to be ashamed of, to be avoided at all costs, rather than as statistical noise within a larger pattern. Here is an illustration. Imagine a coin that is slightly weighted so that it lands on heads 60% of the time. If you bet on heads every single flip, you will lose 40% of the time. In any short sequence of flips, you might lose several in a row. A person without the probabilistic mindset looks at those losses and concludes the strategy is broken. They change their approach. They start betting on tails, they add complications, they introduce emotion, and they destroy the edge they had by refusing to tolerate the inevitable variance. A person with the probabilistic mindset looks at those same losses and sees them exactly for what they are, the expected cost of playing a game that they are mathematically certain to win over time. They hold the position, they trust the process, and over 1,000 flips, they collect their 60%. Simons ran Renaissance like a coin flip operation at massive scale. Not every trade won. Not every model was correct. But the models were correct often enough and with enough consistency that the edge compounded into something extraordinary. The Medallion Fund, Renaissance's flagship fund, did not achieve its legendary returns by being right all the time. It achieved them by being disciplined enough to stick to a process that was right more often than it was wrong, and by sizing positions in a way that maximized the mathematical advantage without exposing the fund to catastrophic loss. This is risk management through probability, not through hope. And it is a framework that almost no retail investor applies, because almost no retail investor has been taught to think in distributions rather than in outcomes. You can begin applying this today. Before making any financial decision, ask yourself not whether this will work, but rather, what is the probability that this works? What happens if it does not? And does the expected value of this decision justify the risk? Expected value is a mathematical concept, but it is also a life philosophy. It asks you to think not about the single outcome in front of you, but about the long-run average of all outcomes produced by this type of decision. When you start living by expected value, small losses stop being devastating and start being informative. And the compounding effect of consistently making positive expected value decisions will eventually outperform any strategy based on trying to pick winners. The fifth rule is the one that ties everything together, and it is the rule that Simons embodied perhaps more completely than any investor in history. The middle class measures wealth by the things it can see: the house, the car, the salary, the visible signs of success. The wealthy measure wealth by the things that cannot be seen: the systems, the compounding positions, the asymmetric bets quietly accumulating in the background. This is the iceberg principle applied to finance. What the middle class calls success is the surface. What actually drives long-term wealth is the 9/10 below the waterline. Simons lived modestly relative to his wealth for most of his career. He was not building Renaissance to drive luxury cars or to be photographed at glamorous events. He was building it because the intellectual challenge fascinated him and because the system worked. The money was the output of a working system, not the goal around which the system was built. This distinction is critical. When money becomes the goal, decisions get distorted. People take shortcuts. They chase returns that look attractive but carry hidden risk. They make bets based on how things look rather than on what the data says. Simons never chased. He built, and then he let the build do its work. The iceberg principle also applies to how wealth accumulates. The visible part of Simon's success, the billions, the fund's performance, is what people talk about. But the invisible part is 20 years of building, refining, testing, and iterating on models that were wrong before they were right. It is thousands of decisions made in the absence of emotional comfort. It is the compounding of marginal advantages over time spans that most people cannot hold in their minds because they are too focused on where they want to be next year instead of where a consistently applied strategy will bring them in. 30 years. Compounding is mathematical. It does not care about your feelings, your timeline, or your impatience. It only cares about the rate and the time. Simons understood this with a precision that most people never achieve, and he structured his entire approach around maximizing rate and protecting time, meaning he never allowed catastrophic losses that would reset the clock, and he never sacrificed long-term compounding for short-term visibility. Now, let us bring this to a place that is real and actionable, because understanding these rules is worthless if they do not change behavior. The first thing you must do is audit your relationship with time and money. Write down every source of income you have, then ask yourself honestly, if I stopped working tomorrow, which of these would continue? If the answer is none, then you are entirely in the time for money trap, and your first priority should be building even a small system that generates returns independently of your presence. It does not need to be large. It needs to start, because compounding rewards starting far more than it rewards perfecting. The second action is to create a decision filter based on logic, not emotion. Every time you are about to make a financial decision, pause, write down the data that supports the decision, write down the data that contradicts it. If you cannot articulate the logic clearly in writing, that is a signal that emotion is driving the bus. Simons would not have approved a model that could not be expressed mathematically. Apply the same standard to yourself. If the decision cannot be expressed logically, it is not ready to be made. The third action is to commit to closing the knowledge gap. Choose one area of financial or investment knowledge that intimidates you and spend the next 30 days deliberately studying it. Not casually, deliberately, with the mindset that understanding this thing will give you an edge that most people in your position do not have, because it will. The gap between what the wealthy understand about money and what the average person understands is not intelligence. It is exposure and willingness. Close the gap deliberately, and the opportunities that were invisible will begin to appear. Before we close, we want to hear from you. Leave a comment below with one sentence describing how you will apply one of today's lessons to your financial life this week, not next year, this week. Specificity is what separates intention from action. And in Simon's world, intentions that cannot be operationalized are just noise. If this video shifted your thinking even slightly, give it a like. It tells us that the depth and precision of this content is what you want more of, and we will keep delivering it. The world Simons inhabited was not built on luck, charm, or insider access. It was built on the recognition that markets are systems, that systems have patterns, that patterns can be decoded, and that decoded patterns can be exploited with discipline and consistency. The 5 rules we covered today: building systems over salaries, eliminating emotion from decisions, leaning into complexity, thinking in probabilities rather than outcomes, and measuring wealth by what cannot be seen rather than what can. These are not secrets, they are principles. And principles, unlike secrets, can be applied by anyone willing to internalize them deeply enough to let them change behavior. Simons did not have a different brain than you. He had a different framework, and frameworks can be learned. The question is not whether you are capable of thinking this way. The question is whether you are willing to do the uncomfortable work of unlearning the framework you were handed and replacing it with one that actually produces the outcomes you want. That work is not easy, but it is logical. And in a world governed by mathematics, logic always wins.